Before we wrap it up on this edition of Markets at Lunch, here's another big market voice for you on the show. Nomura's Prabhat Awasthi says risk-reward is more favorable for emerging markets right now. Global growth in the first half of 2019 will be impacted by simmering trade tensions between both US and China. But he says that Fed risk may recede as the central bank may hit a pause button on rates post the month of March. Listen in.
So I think the investing landscape actually is very different from what actually happens, because at the end of the day, people anticipate rate hikes. So whatever you anticipate, and if you get more than that, then it's negative for investments. Otherwise, whatever. So I think what happened in US this time around was that people were expecting a bit dovish commentary and sort of didn't come out as dovish. But whatever is there has been now put out, right? So it's sort of 2 more hikes is sort of put out now. So market has moved in the direction. Incrementally, if things get worse in terms of rate hikes, then that can be negative for the market. But I think markets tend to digest whatever news comes out very quickly. I mean, couple of days, these days at best, couple of days or 3 days or 4 days. So my guess is that I think when you talked about global environment, our overall sense in Nomura is that it'll be, growth slowdown is something that's going to happen globally, in US, in China, across globe. And part of the reason is that you've seen a huge amount of stimulus in the past. Your monetary policy was too loose, sort of getting tightened now. There are trade frictions which are happening. So end of the day, coming from a sort of very, very benign environment monetarily, fiscally, we're sort of moving into the other direction. And that I think will definitely sort of have some marginal changes to growth. I mean, definitely changes to growth on the negative side.
So how do you think emerging markets will actually cope with a slowdown led by US and China? Do you also see a prolonged pause by US Fed in that light?
So I think there's not one simple unidirectional answer to this. I think the important point essentially is that when the growth was good, it's not that EMs were doing extremely well. Part of the reason was that rates were rising and money was flowing to DMs rather than EMs. And the growth in US was probably stronger while the growth in EMs was still struggling. And the fact was cheap money was getting over, which was also fueling asset prices in emerging markets.